Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host. And so today we're going to start off with a tax tip, and we're going to get into a lot of juicy stuff that happened last week and over the weekend. So, Kelly, take it away with a tax tip, and we'll start with you.
Well, okay, thanks for having me. Well, today's tax tip, I think, is a bit of an offshoot from one I intended to dish out a week or two ago, and that was to cite a good tax tip for highly compensated W-2 type people is to start a side gig. And I'll have to look at my notes to see if we talked about that yet, but if we haven't, then I'll hit on that one. But assume you have this side gig that you started. It's your passion. It's your dream. You wanted to. I did talk about this. You wanted to be a hockey coach, right? That's you, Kirk, right? Or you wanted to run a hockey clinic, right? So let's say you started that side gig, Kirk, and now you need to do something with it. One thing that you could do is I know you've got a couple kids. You've got two boys that play hockey, I believe, right?
Yep.
Now, they might be a little young for this, but let's say they're in their bantam level or they're, close to high school, that kind of thing. What you could do, certainly if they were in college, right, when they're playing hockey for BC, you can put them in this thing where you pay them for your side gig. You pay them 1099 compensation, W-2, probably not, right? Unless you're doing something big with it. But pay them. This isn't just to get a write-off. To be clear, I'm not suggesting you could pay your kids and you get a tax deduction for that. Well, you can pay your kids to work for your side gig enterprise and you get a tax deduction for that. So rather than let the kids sit around playing video games, put them to work growing your hockey coaching clinic enterprise. They can get on social media, pay them for that. They can do Facebook, they can promote it, have them send out flyers. I had to work for my dad for 50 cents an hour, right? So put your kids to work for your side gig enterprise, and then they can pay for their college with the money that you have paid them. And to me, that's a most overlooked, obvious tax tip. Put your kids to work. That's fundamentally a good thing, right? Kids, let's face it, they don't need to be sitting around doing nothing. They can work for the family enterprise. Family enterprise gets a tax deduction, and they get to pay for their college. Everybody wins in that, except the IRS in the state of Massachusetts. That's my tax tip.
Awesome. Well, I appreciate that, Kelly. And I'm not worried about the IRS or the state of Massachusetts winning, although the state of Massachusetts DOR is they're the less pleasant of the two, from my understanding. So,
Yeah.
Well, great. Well, Kelly, I really appreciate you coming on the show and sharing your wisdom. And thanks for joining us. We'll see you again on the next show.
Okay. Thanks. Take care, guys.
All right. Well, that was good, and I can assure you that I am going to be putting my oldest son to work this summer, whether he likes it or not. And I'm not sure if I'm going to pay him, but he's doing something. He's getting some work done. He's not going to sit around playing video games all summer. That's for sure.
Hey, Kirk, I'd like to add to this actually, because it's a really good segue. As you know, what Kelly was just talking about is right in my wheelhouse when we talk about college planning. So this is something that we work on with families. We call it the tax scholarship. And one of the things to be aware of is that for families that have kids in college, there is up to $2,500 per year that they can get as a tax credit. It's called the American Opportunity Tax Credit. It is a combination of a couple different tax credits that are child-based tax credits, but they actually phase out around just under 200,000. Okay, so for a lot of families, they don't qualify to be able to get the American Opportunity Tax Credit. Well, what Kelly was talking about can be a way for you to qualify for the American Opportunity Tax Credit by transferring the filing of that tax credit from you at your income where you may not earn, you may not qualify, to your child. And basically it's you have to have at least about $3,500 in qualified tuition expenses per year to get the full $2,500 tax credit. Now what happens is that when families are obviously, again, he's talking about business owners. Well, a standard deduction for a married filing jointly, most people, as you know, Kirk, business owners with a K-1, that passes through to their personal income. So, when you start getting above $190,000 in income for a joint filing, you're paying 24% on every dollar above that. So really quickly, what you can do is you can actually pay your child. And when you pay your child in 2023, a single married filing separately is going to get $13,850 in 2023, tax-free. That's the standard deduction now. So your child can get $13,850 and not pay any tax on that. Now, what happens? You start to pay them above that. So zero tax on the $13,850. You can then pay them another $11,000. And at that point, it's only a 10% tax rate. So there's only $1,100 total. Then you pay them another $11,666 above that, which is only $1,400 total tax to them, because now they're only at the 12% tax bracket. So what have you done? You've now paid them up to about $35,000, $36,000, actually $36,616. At that point, their total tax is only going to be $2,500. So guess what? The child files, the child claims the American Opportunity Tax Credit. Guess what? They get $2,500 back, which wipes off the entire $2,500 that they would have paid in tax. So therefore, the child has now made $36,000, almost $37,000, tax-free, no taxes. Now, what does that mean to the parent? Well, the parent's roughly around the 30% tax bracket at that point. So in the first money that you're paying, the $13,850, you're going to save almost $4,000 in taxes. Then you pay them that extra 11, then that extra 11,666. So now you've paid them $36,000 in taxes. Now, if you're at a 30% tax bracket, that is a savings of around $10,000 to $11,000 per year. Do the math on that, Kirk. Over 4 years, $42,000. That tax savings alone could pay for 1 year of college. So that's just, to add on what he said, we talk about it all the time with our college planning, but I wanted to take a couple minutes there to explain what this means. You can pass almost $40,000 to your kid, take a $40,000 deduction, and give them almost $40,000 for free, and qualify for a tax credit you wouldn't qualify for. Again, just a simple thing, why it matters to have college planning.
Well, Doug, I just learned something today. Thank you. That's brilliant, and I can tell you, I certainly like the idea that Kelly had of paying my kids 50 cents an hour. what I'm paying them for chores now is certainly a lot higher than that. But no, that's brilliant. I love that tax tip, and I think for anybody who's sending their kids to college, you need all the tips you can get when it comes there. It is ridiculously high and only getting higher when it comes to college. Although I did see a chart the other day that said the title of the chart was "College is starting to see deflation," and I was laughing because it showed the chart. It was up like 20% in the last 2 years, and it was like flattening out for a month. I was like, okay, I'm sure that's what's going on.
Well, that's what we always talk about with inflation, right? It's like, ooh, inflation was up 9%. Now it's only up 3%. We've had a 7% deflation. No, we have not. We're still going up. We're just not going up quite at the same pace. Welcome to college. They've jacked you for 2 years, and now you might get a little bit of reprieve and not getting jacked up so much over the next couple. Congratulations.
Yep, we live in an interesting world where up is down, left is right, and I won't get into the next joke. It'll probably be off color, but anyway.
Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
So let's dive right in. We got a lot to talk about. There's a lot in the news. I know you're on vacation, and hopefully you're all nice and rested and ready to go here. So let's dive right in. So
Not at all, Kirk.
What?
It's called, as a friend of mine always says, when you go on vacation with the kids, it's not a vacation, it's a trip. And so, yeah, we're not then you add in jet lag. Hey, we're just barely hanging in here, but thankfully I've got you to spend that time with today and keep me upright. So
thanks, Doug. So yeah, my phrase about it is vacation is not a vacation. It's just home somewhere else.
If anybody wants a good laugh, go Google George Carlin. I forget what it's called, but if you Google vacation or trip for George Carlin, he has an entire bit on how all we do is pack our house into a smaller house, into a smaller house, into a smaller house, just to take and relocate it. So kind of what you're saying, it's one of, again, Carlin's a genius. It's one of the funniest things he ever did.
I'll have to look that up. He's one of my favorite comedians, and sad he's no longer with us. But yeah. So all right, well, let's dive right in. So here's some news from last week. So the Federal Reserve met and raised interest rates 25 basis points. The market was getting a little antsy. They thought it was going to be 50 basis points, and they only raised it 25. So the market had a big sigh of relief and started climbing higher. Okay. What
did we just say about deflation? Ooh, everything's better now, even though it still just got more expensive.
Yep. Change the expectations. Oh, it was up 50. Oh, no, it's only up 25. Up. Oh, celebrate. Everything's going up. And apparently they also said that they were going to have just another 25. And then I didn't actually listen to it because I was in the middle of meetings. But basically they alluded to, or let me reframe that. I don't know what they actually said, but what the market thinks, which is actually more important. So what the Fed could have said was, we're going to raise it 25 basis points and we're going to pause. I think that's basically what they said. What the market read that as, we're going to do another 25 basis points, and then they're going to start dropping. That's how the market reacted to it. The yield curve dropped significantly over the week, and all of a sudden, everyone thinks that the Fed funds rate is going to drop I think it's basically like 1% in the next 6 months. So they're assuming that the Fed's going to start dropping rates and everything's going to be sunshine and roses and leprechauns coming out everywhere and tech stocks are going through the roof. To me, this has been the problem the whole last 12 months, or it's longer than 12 months now. It's whatever it is, 15 months. When the Fed started raising rates, or talking about raising rates, so to speak, when last year, when the yield curve just kind of blew out and everybody freaked out and lost money, which caused the SVB collapse, or at least one of the reasons. So the problem is the market is a forward pricing mechanism. So the market looks ahead about 6 months. Okay, and this is why this all happened. I want to kind of lay this out for listeners, because if you don't follow this, you might be missing it. So the Fed raised 25 basis points. You might think, well, that should send the markets down. It should be crazy. No, the markets went up. Well, why did that happen? Well, it happened because the expectations prior to the Fed meeting were that they were going to keep raising rates till about 5.25, 5.5, somewhere in that range is kind of what the expectations were. And the Fed said, well, basically, we're going to raise it 25 and we're probably going to pause it for a little bit. And what the market read that as pivot, right? I didn't see the word pivot anywhere, but basically the market's reading it as pivot, which means it's going to start dropping. Rates are going to stop dropping, which means 6 months from now, the market is expecting that rates are going to drop about 1%, which I think is crazy. But that's what the market is expecting, okay? So that everything is being priced around that expectation. And I saw something on LinkedIn the other day, and it was I guess a day by day or week by week chart. It was I forget who it's by, but it was brilliant, and it just shows the yield curve, over the last few months and where it's going and the expectations. And after the Fed meeting, it just dropped like a stone. So the expectations are going to start dropping rates. Now the market is pricing that 6 months from now, which means that it's pricing it in today. So that means tech stocks are climbing, financials are dropping, and the stock market is up a little bit. But the point is it doesn't really matter where rates are going to go. The market is basing it on where they think it is going to go. Now, what I find really interesting is for the whole last year, maybe since not the whole last year, last 9 months, the market has been pricing in expectations that the Fed is going to pivot and start dropping rates. They've been talking about it. They said they're not going to increase rates past this. They're not going to, like, if you look at the past 9 months and you look at the yield curve expectations, which is basically the market pricing in where rates are going to be in the next, whatever, 6 months, 12 months, 20 years, 30 years. That's what the yield curve is pricing in future expectations. So if you look at that and you say, well, the market is assuming that we're not going to go any higher than 4, or it's not going to go higher than 4.5. It's not. They keep raising it, but the expectations at the time are, well, the market is not going to go much higher. I'm sorry, when I'm calling market, I mean rates. The market rates. The Fed funds rate is not going to go much higher. So then, when it goes there, they're like, the Fed's like, no, we're going to keep raising rates. The market's like, really? Okay, well, you're going to go up 25 basis points. So they've been fighting the Fed the whole time. Now, anybody who's been around long enough knows what is the one thing you don't do in the markets, Doug?
Fight Jerome Powell?
Yeah, you don't fight the Fed. That is a long-held phrase for quite some time. Don't fight the Fed. When the Fed is dropping rates, people say don't fight the Fed, which means, hey, markets are going to go crazy, or they're going to go up. Don't fight the Fed. Don't short it. Well, they're raising the rates, and the markets are not saying don't fight the Fed. They're saying, hey, let's fight the Fed. Let's assume that what they're saying is inaccurate, and let's just start, pushing the stock market up. I think people are going to be in for a rude awakening if they don't pivot, 2 meetings from now and start dropping rates. I think that's inevitably where it has to be. I don't think that they can start dropping rates unless they want really high inflation. I think they're well aware of the fact that we're going to have high inflation if they start dropping rates, and it's going to cause different kinds of problems. So raising rates is causing bank problems right now, which we're going to talk about SVB in a minute. But it's also going to cause high inflation or hyperinflation problems if they don't take care of it. And I think Powell's been pretty clear about this for a long time. We are going to get rid of inflation by raising rates. We're going to cause, as he calls it, a demand destruction, which basically means a recession. I don't see a recession, Doug. Do you? I mean, what's going on out there?
No, I mean, people are acting like nothing's going on. Everything's great, fine, hunky dory. I think I just saw it was the busiest weekend at the Minneapolis airport since pre-COVID. People were definitely spending their money traveling. There's some charts that we've seen where all of a sudden, out of the blue, what was looked to be a declining demand for housing and what seemed to be a declining demand for cars, all of a sudden is spiking, and home prices and auto prices are jumping again. I mean, there just seems to be absolutely no stopping to the amount of economic movement that's going on right now. And again, I know we've seen some charts too that have shown that there has been a significant reabsorption of money supply, but I'm not sure those charts really have a clue. I mean, what did they say, Kirk, after COVID? How many billions, if not trillions, of dollars were missing and unaccounted for? So if they haven't been able to, identify where that money went. How do they know that money's been absorbed fully? And I think that if you look around you right now, people are just, they still have an incredible amount of risk on mentality to go in for the market. I think that they are definitely looking at spending and I think there does seem to be this optimism that, hey, the market's already bottomed out, everything's good, the future's going to go. But I want to go back to what you said. You said don't fight the Fed. Listen, you mentioned something that in their interpretation. At any point did Jerome Powell say he was doing anything different? How has that played out the last, I don't know, 5 or 6 times that the markets have interpreted differently than he has said verbatim? He's proven them wrong time and time again. So
yeah, it's crazy. And I want to get into housing because I know we haven't talked about that in a while. I want to talk about a few charts here. And then we can get into that. So I've seen some interesting charts over the last week, and I want to just kind of share this. So this is a grid of the big banks, and somebody did this on Twitter, and I wish I could give him credit because I don't have who it was offhand, but this is a list of the largest banks. It's not all of them. I don't see M&T Bank, and there's a few others that aren't on here, but if you look at this, you're starting to see a few of the big ones knocked down. Well, who's in the middle? Who's the bingo right in the middle that's going to connect all the lines? It's JP Morgan. So I thought that was a funny piece. But I think in reality, here's what's going on. And I think, it's important to talk about this because there's a lot of, there's still a lot of stress in the banking system. Now, over the weekend, First Citizens Bank shares offered to buy most of Silicon Valley Bank following the lender's collapse. Now, what that means is they're not buying all of the bank. They're buying the best parts, and the rest is going to go to the FDIC. So, it'll be really interesting to see what happens there. But basically, one of the banks stepped in and got a little larger, and Silicon Valley Bank is kind of taken care of. So that's where the FDIC comes in, and they didn't have to do too much, but they definitely have to do some of it. I haven't seen the news about Signature Bank you see how Credit Suisse got taken over by UBS last week. This is just like, you can't make this stuff up. This is like early 2008 when this stuff was starting to happen, where the markets weren't crazy yet. They were just a little crazy, and they swept a few of these things under the rug. Credit Suisse is not a small bank. They're not tiny, and they got taken over by UBS effectively. Let's just say it was a good deal for all parties, I'm sure, but they got taken over by UBS. Think about that. You've got an enormous bank taken over by another enormous bank. This kind of brings me to like the Highlander movies. There can be only one. I don't know if you, I'm going to do a throwback here for all the Gen Xers, the Highlander movies, where, this guy, Connor McLeod, was going, like, there's a thing called the quickening where basically, all these kind of, I don't know what you call them, immortals were walking around, and they would take each other's head. They get in a sword fight and they take each other's head off. And when they did, they got all the power and special powers of that person. So some of these people had like special powers, and they would get that power into this person. So you would acquire their special powers, which effectively at the end, there was only like 2, and they would fight, and at the end there'd be only 1, right? And that person would be, whatever god of that was kind of the thing. Anyway, the point is it brings me to the banks, right? There's all these banks, and over time they do stupid things, and they get taken out by larger banks. At the end, there can be only one. There's going to be one bank, and I'm not going to say what the name's going to be. But you also had news about people are worried about Charles Schwab, people worried about First Republic. There's worries about all these different banks, and I don't know if there's validity to it. I'm not a banking expert, but I do know that when there's blood in the water, you don't want to be in the water. And I think that some of these banks, all it takes is a rumor. One small rumor, and people are going to go running. And where are they running to? The larger banks that they feel are too big to fail. And you know who they are, because they were too big to fail in 2008, and now they're still too big to fail. They're even bigger to fail. but you also have, there was X's over some of these names like Deutsche Bank, which I don't believe that. I don't believe anything's technically happened with them, although people are talking about what to do with them. And I don't know if First Republic is technically down yet. I think people are talking about what to do with them. But the point is, when there's blood in the water, there's going to be sharks swimming around, and they are. And people are pulling money out of regional banks. So there's a call right now for the FDIC and the Federal Reserve to step in and come up with a strategy to help the regional banks, because what's happening is people are looking at their smaller or regional banks and saying, well, it's probably fine, but I don't know. So I would rather put all my money with Bank of America, JP Morgan, Wells Fargo. And there's news that like thousands and thousands of applications are going into Wells Fargo because people are deeming it too big to fail. So they're just saying, well, if I put my money there, at least they'll get bailed out and I'll be okay.
Wait, Kirk, are you saying Wells Fargo actually has legitimate applicants now to opening for their savings accounts?
I'm not saying that, Doug. I am definitely not.
They don't have to make them up this time. I mean, the bonus program's got to be off the charts.
I'm not making that claim, Doug. I know I've been stung before and not making that claim. Who knows if they're real applicants, but I would assume they've learned their lesson. But
let's go check Wells Fargo's bonus program, bonus promo right now for its tellers. You never know.
Yeah, well, there's an old saying in Wall Street, and I'm going to paraphrase it, which is, you do something bad, you get fined, you do the time, and then you start it up again like a year or two later. So, this is, and I'll just point this out because this is actually something I hate about the financial system, is if you're too big to fail, you get bailed out, you get fined. So you made like $1 billion on something, you get fined like 100 million. Well, what's the incentive to not do that again? And this happens.
And all the executives are protected from it and liability. So of course they have none of them have any real culpability, because people forget these are not companies that were started by entrepreneurs. These are just employees that are basically paid in bonuses. So what is their incentive?
Yep. And here's a chart which I found to be really humorous, because you got this line going in and out of the guy's ear. But basically the executive pay at Silicon Valley soared after big bets on riskier assets. And I believe this guy's bonus, and he also sold like a few million shares a week or two before they went under. So
Kirk, he also, and there was another post, he also sat on the San Francisco Federal Reserve Board. So good question for you. As they're betting into those long-term bond strategies, wouldn't you think he has the ear of what's actually going to be voted on in the Federal Reserve with regards to interest rates, to where it would make some sort of sense and insider information to have, I don't know, pivoted a little differently than some of their investments? But hey, the bonus was pretty enticing.
It makes you wonder, every time you think that there's a cabal of really wealthy, smart people running the country, kind of makes you wonder, maybe that's not true. If you have the inner circle and you can't figure it out with months and months, a year of, was a year and 3 months of preparation since the rates were going up. If you don't how
many times did they go to Jackson Hole, have a nice Chianti and fava beans and talk about what was going to go on with interest rates? I mean, he's in the room with Jerome Powell, and he's not listening to Jerome Powell either. Maybe he should go work for Wall Street.
I totally agree, Doug. I think it's crazy. These people, you'd think that they're running the world, and it's clearly they're not. Because if they were, they would have an inside track, and this wouldn't be a problem. But let's dive right in, because I want to get to housing towards the tail end of this, because I think that's an important thing to discuss again. But I do want to talk about a few of these charts. So you talk about the Fed's balance sheet was shrinking, and people were really worried about that, because every time the Fed balance sheet shrinks, you tend to have a market sell-off, if you will. And I don't know if it's correlation or causation. People call it causation, but frankly, in the financial markets, you never know if it's correlation or causation. But the reality is if people are looking at that and thinking it's true, then it causes it to be true, which is what we call reflexivity. So I want to talk about a few of these charts. Basically, you have $500 billion in 2 weeks that went to the bailout of the SVB, which increased the balance sheet. And I think, what you should take away from this is, even though they were reducing the balance sheet, it all of a sudden spiked up. Now they may continue to reduce the balance sheet, but it's still higher than it was a few weeks ago. So just something to keep note of. I also want to point out that if you want to talk about where, and this is something that people aren't really talking about, and I'm really furious about this, Doug. We talked about this a few weeks ago. I'm mad because if you look at the banks, right? How much is your savings paying you? It's like on average, I think it's like 35 basis points is what your savings account or checking account is paying you. 35 basis points. Do you know what the Fed funds rate is? It's 4.75 to 5%. You're getting a week ago, you were getting 5% US Treasury bonds, 5.3, I think, at the peak, Thursday before SVB incident. I think it was 5.3 I saw for like 1 year or less. 5.3. The banks are paying out 35 basis points. For all those of you who don't know what basis points are, they're 0.35%. It's a third of 1%. It's nothing. They're basically they're kicking you in the family jewels and just saying, how do you like them apples? Like and people are smiling. They're saying, oh great, I'm going to keep my money here. Why people have more than 250,000 at a bank is beyond me. When you could be getting, you could have been getting 5% on your money, and these banks are just smiling because people are keeping their money there. Why people keep their money there is beyond me. So here, this chart, what it's showing is it's showing the different rates. It's showing the money market fund rate at a bank. It's showing the Fed funds target rate. It's showing the money market fund yield. It's showing the money market deposit accounts, and it's showing savings rate and interest checking rates. Interest checking is still close to zero. You get close to 50 basis points of money market deposits and savings rates. It's nothing. While you have the Fed funds rate and basically US Treasuries or T-bills is close to 4.5 to 4.75%. It's crazy. This spread is enormous. Banks are cleaning up. They're making tons of money if they're half intelligent. That is not something that should happen. It should be a very minor spread. And actually, to be fair, the banks weren't making much money on this for the last 14, 15 years. They weren't making much money on it. So to be fair, they've also been taking it in the gut for the last few years. But right now, people aren't doing their homework. Investors, savers, people with money, with cash, you're not doing your homework. Do not have your money in these banks. They're not paying you enough. Stick it in US Treasuries. And I'm not making a recommendation. Everybody's different. Put your money wherever you want. But I'm saying if it was me, I would not be putting money in banks. I'm not keeping any more cash there than I have to. I'm keeping it in things that are yielding me a good rate and are not highly risky. Right now, banks, they're risky. There's always this contagion effect that could happen. I'm not suggesting it will. I'm suggesting that you don't know if it will. So why take the risk? And if the whole country was listening to me, I would not be saying this because I don't want to cause a bank run, which is the whole point of this, right? Bank runs are psychological. But I have I probably have the smartest people in the country listening to this show. We have a lot of smart listeners listening to the show. Do not have your extra cash in banks. If you have over 250,000, don't have it in a bank. Put it in a treasury. Put it in ICE, like I-bonds. Put it somewhere, but don't put it in a bank earning you 35 basis points. Get your money's worth and make sure that it's safe. Make sure it's not in some, high risk money market fund that you don't know what it's invested in. Make sure it's safe money. Make sure it's in treasuries or something safe. Short-term treasuries, ideally, which are the safest. So that's what I would suggest you do. If you have a lot of money, please, I believe me, I'm a big supporter of cash. I think cash is a great place to have your money right now, but don't have it in actual cash in your bank. Have it somewhere that's going to be earning you interest and is safe. Banks are not necessarily safe, so I want to be really clear about that. Go ahead.
And I want to remind people too that if your bank you were talking about interest checking, that shouldn't even exist. Okay, I want to remind people that checking accounts were intended to be demand deposit, money available, reserves there. You get the money there. The money there is immediately accessible. As I've said in previous shows, and I won't go into all the history again, they changed the rules. They allowed banks to start giving you interest to entice you into the check accounts. The only way a bank can pay you interest is if the money isn't there, because they got to loan it out to get interest to pay you. So if it's an interest-bearing checking account, you should know right there, there's risk. That's what SVB went into. The first question you'd be asking on your checking accounts, are these demand deposits? Are the reserves covered on that? Because that's the intent of your checking account. It's not there to have interest. Interest is something you should earn elsewhere. And right now, there's nothing else the banks are offering you that are giving you anything worth having your money with them.
Yeah, totally agree. I want to touch on one or two more topics. We're going to head into housing here. So this is a chart. Thank you for forwarding this, Doug. This is a chart of March 8th to March 13th, and it shows basically future expectations of the future Fed funds rates. Okay, now don't worry about the details. What I'm showing you is the huge variance over a short period of time, in large part because of SVB. So what this shows is the future expectations where it hit a rate and then it would come down a little bit March 8th. And then as you go to March 9th, 10th, it started to drop. And then you look at 12, 13, actually started to be negative where they're expecting huge drops. So the point is in a very short period of time, you had a normal market where expectations were pricing in the future and everyone was on board with it and they were probably reasonable. Now the market is pricing in huge drops in rates, which means to me that is also at an extreme. I think the market before was probably priced correctly, and I think if I had to speculate, and obviously don't pay attention to me or anyone else about the future because no one knows it, but I've been beating this drum for a while and I've been correct that the Fed is going to keep rates high longer than people expect, and I've been saying this for over a year, and people eventually they'll kind of wise up to it. But if you look at this is probably closer to reality at the top, March 8th, but the bottom, I think it's way off. Because what that's pricing in is the market is going to implode and they have to start dropping rates because the market's going to implode. Is the market going to implode? I don't know. Maybe the Fed knows something I don't. If you could tell by the SVB guy who's on the board, apparently nobody knows anything. So I don't think they know anything. But if you think about future expectations, if they start dropping rates, it's going to cause a spike in the market prices. Assets are going to go through the roof and people are going to party and it's going to cause hyperinflation. It's going to be a disaster if that happens. And the Fed knows it. So they're not going to do that. So I'm just thinking, like, how are we going to one up the Fed, right? The Fed knows they can't do that. The best case scenario for what the market wants is that the Fed basically flatlines and they pause for a while. And they just pause and see what happens. Let's see if the system keeps breaking, right? Right now, the market thinks, hey, things are going to go great. Rates are going down. That allows these banks to reprice their portfolios. So think about it. If I'm a cabal leader and I'm leading the cabal of the world, right? And I'm sitting here saying, what would I do? Okay, well, you find a reason to have rates drop in the future so I can get out of my bad positions, right? And then I can get out of them without a huge loss. It'll be a loss, but less of a loss. I can switch out and do something smarter. And then all of a sudden they're like, well, we're not going to drop rates for like 6 months, which I think that's probably more reality. And all of a sudden the rates come back to where they were before. I mean, that's how markets work. And I'm not saying it's cabal. I'm saying if I were running the world and running the global economy and I wanted to bail people out, that's exactly what I would do. And, I think the reality is the street kind of works that way. I don't think there's a Dr. Evil or Blofeld running the world this way. But I think the markets as a whole, they kind of do this in a way to rejigger the system. So there's creates more volatility, which allows Wall Street to make money through volatility. It has nothing to do with the future. It's just, they like volatility because that's how they make money on the spreads. So anyway, I just wanted to kind of touch on that because I think it's important to understand that things can change quickly. And the future pricing mechanism 6 months from now can change really quickly. And this is what you need to know. So, Doug, we're going to get in. We're looking at like early on some of these charts here for housing. I don't know if you want to kind of dip into this, but I think it's really important that we touch on it. Well, so we're looking at housing, right? We're talking about interest rates, and people are celebrating because interest rates are dropping. And I haven't looked at the mortgage rates, but I'm sure they're dropping right now in expectation of the future. But I want to show you some charts about housing because the housing crisis is not over. Rates are not going to start dropping like a stone. If they do, then I'd actually be more scared. Like if the Fed came out last week and said, you know what, we're going to drop rates instead of raising them, I would be scared because that means they know a lot more than the street knows and everyone else does. And I think the market would crash. Even if they paused rates, I think the market would have went down because they would have been scared. Like, what do we not know about the market right now? So if you look at housing, this is basically season adjusted data. And it shows, compared to a year prior, it shows that the shift in home prices. So recently, median home price went down for the first time since, I don't know, since like the late aughts. So it was 2008 or 2005 or whenever it was. Whenever the home price, I think it was 2010, the home prices stopped going down, somewhere around there. So since then, this is the first time median home prices started to drop. And you know this, Doug, last year, median home prices rose 10%, even though home prices were unaffordable and they should have dropped 40% if they were to retain that same affordability. So we're starting to see, especially in the West Coast, that home prices are dropping, in somewheres between -5 and -10%. And the rest of the country is dropping a little bit, but not much. So I just point this out because not every place is the same. Okay. So not every place is going to drop 10 to 20%. And we made that call a few weeks ago that this year that home prices are probably on average going to drop 20%. And I think that should be reasonably accurate. It's not going to be everywhere. So if you call me and you're like, I live in Boston and home prices only dropped 3%, don't call me. Okay. You're missing the message. Not every place is going to drop 20%. Some places might drop 2. Some places may drop 40, right? We don't know, right? As a whole, as an aggregate, the median should drop right around 20%. I think that's reasonable. What do you think, Doug?
Well, I got to tell you, looking at this chart, a friend of mine had been living in the San Fernando Valley area of LA for the past 15 years, and he sold his house in spring, summer of last year and moved to New York City. And I got to tell you, looking at this chart here, I talk about hitting the lottery, right? Because you're seeing Southern California. I mean, basically, central coast of California to Northern California, all the way down red. You're looking at areas like Las Vegas, which we've talked about as being one of those that, unfortunately, as much as it always climbs, Las Vegas, we go back to the Great Recession before, Vegas was one of those that got slammed the hardest. All along the West Coast, what stands out to me in a couple places is definitely looking at Mississippi, Dallas, Idaho. Idaho has been a hot place to buy real estate over the last 15 years. But again, for most people, it's not a booming job market. So it's a lot of it is probably, secondary homes and then people that have moved there to support those lifestyles. But, if you look at the Midwest to the East, it's really interesting how little, especially with the concentrated population density of Florida and the East Coast, especially, the Northeast, how they are not showing a very significant amount of seasonally adjusted decline. So, I know there's been a massive flight of people moving west, but I think, there's also starting to see, and there's been more talk of people kind of moving east away from some of that again, especially as there's been, a lot of talk around taxes. And, people talk about tax. I mean, again, I'm reading this as my opinion, but you talk about the impact of taxation. They say, raising taxes isn't going to affect, the demand there. A lot of jobs. I know this for, even though Dallas is coming down, but a lot of jobs that, kind of were booming. Some of these cities are actually jobs that left the West Coast, right? Because of taxes. So, I think you start playing into some of those things. You start looking at, the data of kind of where you're going to see those declines. We talk about averages, right? A 20% decline. Like you just said, maybe your house only goes down 3% where you live. This is, I saw something again on Twitter this morning, which I love to see. It's like, hey, I've already made this much money. And if I just let my money sit and don't do a thing, then 20 years from now, look how much money I'll have. Because people always sit there and reflect on averages and assume they're going to get that average. Markets don't give you averages. Markets are appreciation up, appreciation down. We talk about that all the time. You can go through 13 years of market flat or market declines. And so what we're seeing here is, yes, there might be a 20% decline on average in the markets. But that average is made up by drastic differences depending on where you live. Some of these markets, Kirk, they're talking 40, 50, maybe even 60% declines on values. How long that's going to last, I don't know. That's going to offset the 3% that you were talking about in places, where you're starting to see the blues, right? So yeah, we might get a 20% average, but where you live depending on where you live, you may see a significantly worse or better situation.
Yeah, and I want to point out one or two quick things, and we'll move on to the next chart. Is there's a difference between correlation and causation, and there's a bunch of factors. The Great Migration, which is a big part of this, although that's not all of it. Really, what a lot of this comes down to is there are certain parts of the country that were overpriced. California as a whole, not all of it, because California, there's a wide diversity there. Oddly enough, there's a huge amount of Republican population in there, just not towards the most populated areas. But in terms of geographic area, it's actually most of California. So what I mean is certain areas that are overpriced, like San Francisco was unaffordable for most people. And you look at that and there's, you have to look at where did prices go? So I know around here, the town I live in, home prices went from 800,000 up to 1.7 million for a home in a matter of 2 years, which is ridiculous. Now, does that mean that it's gonna come down? No, not necessarily, because a lot of people around here have money and they're buying homes for cash, and so they don't care. And personally, I look at that and say, well, that's stupid, because home prices eventually have to come down, especially in the high end of the market. But I think what's important to note, if you look at Middle America and many parts of the country that are blue, what that really means is that a lot of these areas, if you look them up, and we'll maybe show this next week, a lot of these areas were not overpriced to begin with. They were still reasonably priced. As expensive as real estate was around the country, there are a lot of parts of the country which are actually pretty reasonably priced. And you could actually rent it out and make a good yield and all that good stuff. And people were focused on Dallas and Florida and all the places that were getting a huge, and Las Vegas and places were getting a huge amount of population, because people were fleeing California, New York, Washington State. They were fleeing them for so many reasons. I won't get into politics, but let's say politics is a big part of it. So they were fleeing and they were going to these places. Well, they just drove up prices, and now the prices are not unsustainable. So just keep in mind that not everywhere is going to drop, as Doug said, but you should note of the places that are. And we talked about it in one of the prior episodes, and we showed some maps of the country and which places are most susceptible. And we'll show that again, because real estate prices haven't really dropped as much as they should. I do want to.
I also want to remind people really quickly, it only matters if you're trying to sell. Right? If you're not trying to sell, who cares? It's your house. A house is a home. It's a place to sleep. So don't get caught up or overstressed by this. But if you are trying to get out of that market and need to move, really start having some very strategic conversations, because even though you're thinking, well, it's down, it might get better, it could also get worse.
Yep. So I want to point out here this chart, because we talked about affordability. This is really hitting at the heart of affordability. It's not all of it, but it's the meat of it, right? Which is basically housing payments, principal plus interest, right? Basically what you're paying to live in a house. So if you look in 2020, it spiked. You could say prior to that, all right, the West was already expensive. If you look at the top, the West is always kind of the most expensive. The Northeast is up there. And as you noticed, the Northeast kind of was a little more sustainable than the West when it comes to 2008, 2010. But if you look at the spike in 2020, everything spiked up. Well, that's not really sustainable if you look at the history of what's affordable. Because in terms of what's affordable, it has to align with median income. If your median income is not keeping up with the affordability, then the affordability is not going to be sustainable. So you can look at all the metrics you want. And I have really smart people talking to me every day about, well, it's demand and supply. I think we talked about this last time. Unless there's caravans of homeless people that can't find a home driving around saying, where I need a house, give me a house, I'll pay anything for it. Unless those people exist, it's not a demand problem. Okay? It's not a supply problem. It has nothing to do with it. People talk about supply. There's not enough supply. It's not. If that was an issue, then like I said, there'd be caravans of people driving around. So that's not it. It's affordability. if you can afford a house based on your income, right? And obviously everybody's different. But if you look at median home price and you look at, median wage, right? And what household income, those have to balance. If one of them is out of balance, where one of them is much more unaffordable and median income hasn't changed, well, then that's not sustainable at a high level. Either income has to rise to meet it or home prices have to fall. But there has to be an equilibrium there. Right now, you can tell there's no equilibrium, which means, if you look at 2020, the West, I think the median payment was somewhere around 1,600. Right now it's 3,200. That's double. So the home prices have to be cut in half out west in the western part, wherever this is distinguishing in the West, in order to come back into the range of what's reasonable. And that's assuming median income doesn't drop, which layoffs at some point should cause that. But anyway, the point is this is a really important chart to keep in mind. If you want to know where home prices are going, just look at this chart. If I can't afford to buy a home, I'm not buying a home, which means that the prices are too high, which means they have to come down in order for me to say, hey, I can afford to buy that home. So that's
Kirk, I want to add something. We don't even have a chart for it, but since we're on the real estate topic, I know we're talking about residential real estate, but I just read something very interesting, and I think it's another concerning layer in the entire economy. This is from a group that I follow, the Kabaisi letter, and I may be pronouncing it wrong. Over the next 5 years, more than 2.5 trillion in commercial real estate debt will mature. Meanwhile, that is by far the most in any 5-year period. Meanwhile, the rates have more than doubled, and commercial real estate is only 60-70% occupied. Refinancing these loans is going to be expensive, lead to major crisis. But the worst part, and this goes back to where we started our conversation, 70% of commercial real estate loans are owned by small banks.
Yep.
Rapidly rising rates are going to teach everyone a lesson. There is no such thing as free money, which I want to go back to because you talked about people buying things in cash. Listen, I know it's like, hey, these interest rates are high. I'd be very cautious putting cash to make a purchase right now. Let's say you've got a home and it's overpriced, and you say, well, I don't want to pay interest rates on that's really expensive. I'm going to pay cash because let's say it's an $800,000 home and you've got $800,000. You put that $800,000 in and the value of that property drops by 20%. Guess what? You basically now have 60,000. You lost 200,000 on your money. 800 went to 600. If you want to get it back out, you're only going to get it out at 600 minus the realtor fee. So now you're down to 500. If you have the cash, I'd still consider financing in many circumstances because at least then that 800,000 is still in your hands. And more than any time, if we've got falling real estate prices, a cash purchase may be very risky.
Yep. Yeah, you might as well just light your cash on fire at that point, Doug. So here's another chart, which is U.S. Median new home price divided by average hourly earnings. This is what I was talking about. So if you look, what sticks out here? And for those of you who are just listening, you can check us out on YouTube, follow us there, and you'll see all this. And you can go to our website as well, and we'll have all the charts there. But look at this, U.S. median home price. There was a spike from 2002 up to 2006, and that was 2005 was the peak in home prices. And then after that, it dropped. Right now, in 2020, we had a spike from basically 13,000 to 16,500. There's a huge spike. That's unsustainable. So this is the relationship between income and home prices, or basically affordability. It's unsustainable at these levels. And I think that's what people need to realize, is it's not only unsustainable, but now we have rates climbing up, which is, even if rates, let's just say rates didn't climb. Okay, this is kind of, actually, this chart doesn't even include last year. Let's say rates didn't climb. It's still unaffordable. And now that rates have climbed significantly, it makes it even more unaffordable. So I think what's important to recognize is that this is more serious than people are talking about. And people are sweeping this under the rug. And frankly, you don't need to go buy a new home. You can rent. You can sell. I mean, if I was you, if you could sell your home for full price, I'd sell it and rent. Why not? You're gonna basically, you got a few years, you can sit it out and then buy it at a cheaper rate. And like Doug said, you're not going to light your money on fire, the $200,000, because your home price is going down, even if you have cash. So I think that's really important. I want to touch on, let's see here. We had another one. Yeah, you know what? We're just going to skip this. It's too complicated. Here's new U.S. mortgage applications to purchase homes, the lowest since 1995. You could just see that people just aren't applying for mortgages either because they have cash, which I think is a big part of it, but also because people just aren't buying as many. So I think that's important. Here's something I did want to point out. Okay, this is an important chart. Now, I don't want to make light of this, and we have limited time, so I want to get close to wrapping it up here. But I want to leave on this chart, okay? What this chart shows is where all the debt is kind of structured. You're going to have, from 2023 to 24, you're going to have an enormous amount of debt coming due maturing. Over $1 trillion maturing in the next 2 years. Now, what this means is all of this debt is maturing at this time where before rates were lower and now they're higher. So you're going to have to, and this is the problem actually with commercial mortgages, right? If you own commercial property, every 10 years it rolls, right? You get a 10-year commercial mortgage, and after 10 years, you have to refinance it again at whatever rate it's at. Well, if the rate was 2% and now it's at 10%, you're not going to be owning that property very long, or you're going to have to pay down in cash, right? It's a problem. And I think a lot of I wouldn't own commercial real estate right now because of that. But what this shows is it shows that there's a lot of maturities coming due, which means that all of the entities that had this debt is maturing this year and next year. If interest rates are really high, they're going to have to roll that debt forward from a 2% fixed income or bond up to maybe a 7% or whatever the rate is, right? Maybe they can't afford that, but this is going to be a real problem for just about every single company that is on the margins that maybe couldn't afford it before, but now they definitely can't afford it. There's going to be a big problem in the high yield bond market that people aren't talking about. I would not be an owner of high yield bonds, and this is not advice, but I wouldn't touch high yield bonds. There will be a time. So, for those of you who are frequent listeners of the show, you know this. We were very down on bonds for years. We said, wouldn't touch them. And all of a sudden, a few months ago, we came out and said, you should start considering bonds. And we got so much hate mail from that. People are like, what are you talking about? Rates are going up. And lo and behold, I said, don't buy bonds. They should start looking at them. So a few months ago, we started saying, hey, bonds are really attractive here. You should start doing it. And what happens? Well, that was close to the peak. You don't know where the peak is, but there's a certain point where you say, within reason, this is kind of a reasonable rate compared to everything else. And you have to compare what your options are. Do you sit in cash, or do you get 5% on your money? Or do you take a chance in the stock market? Maybe it's up 20%, maybe it's down 20%. I don't like the probabilities today, but the point is you have to look at the options, say which is the best choice. And so looking at high yield bonds, I wouldn't touch them right now. I think they're toxic. And there's really a high probability for failure across the board in the high risk areas. However, there will be a time where it's a great time to buy. I don't know when that is. It's going to take some significant event, but there will be a time where high yield bonds are going to be really attractive. 2008, 2009, 2010, really great time to buy high yield bonds. You were getting well into the double digits. You're getting 15, 20%, some cases 30% on certain companies that were solid enough, but whatever, Wall Street didn't think so. It was a steal. Same thing with 2020. You had a steal on certain fixed income that were mispriced. If you're patient, if you're liquid, you can take advantage of those things. But if you're not patient and you're not liquid, you're never going to see it. And I think this is where people don't understand how to invest. They think, well, I'm diversified and I'll ride it up, ride it down. No, if you're not liquid, you can't buy when it's low. What's the first rule? Buy low, sell high. Well, you can't buy low if you don't have any cash. If you have cash, you can. But if you buy too early, then you don't have any more cash, right? So you have to be patient. You have to wait this out. This is going to be a long game. The market might even go up for the next month. Sell in May and go away. You probably have about another month or two where the market might even rise. And I think that would surprise me. But at the other hand, I'm not totally surprised because that's how the markets work. I'm not, personally a buyer. I think the markets are really too volatile and there's just too much unknowns still in the mix with the banking sector for me to get excited about it. But I think for some people, if you wanted to make a quick trade, I think you could probably do okay. But But anyway, so and I just want to leave on this chart. This was 1 in 5 homes for sale in 2022 was affordable. It just kind of goes to show that things are just unaffordable in this market. So Doug, and this last chart's pretty good too. It just shows and this is from Reventure, up above or below the line. Don't buy if it's above, buy if it's below. Right now, we're as high as it's ever been in the last 20 plus years. So just kind of goes to show in housing how far off the mark people truly are. Anyway, we're gonna end it there. Doug, final thoughts from you, and where can we find more about you?
Yeah, thank you. Well, you know what? I think Patrick has posted a couple of things in the notes here, and I appreciate all of that. And can't address every one of your points, but one of the things I did see in there is rents are at all-time high. We addressed that on a couple meetings ago, or a couple of these podcasts ago. It depends on where you live. In certain places, it is actually cheaper to rent than it is to buy. And of course, everybody's situation is different. Talking about, having higher equity, having freer cash flow, again, having liquidity is important. Again, people have listened to me, know where I stand. I would never put any extra dollar and give it to the bank as a free loan. That's my personal opinion. If I have the money sitting around, I've got the flexibility and liquidity to do with it. Equity to me is something that it only works for me if I can sell and if the banks are willing to borrow. And given where banks are right now, I think it's going to be a continuing tightening of availability. I'd rather keep my cash, have that flexibility. You can do short-term bonds, do a lot of things. So depending on where you live has a huge amount of impact. And again, as we've said, there's definitely areas in the Midwest where it's still a lot easier, a lot cheaper to buy. I think it's predominantly, but also in other areas than it is to rent. There's other areas like in some of those red areas on that map that it's actually better to rent than it is to buy. So definitely know your market, get the information and make some smart decisions. We're not giving advice here. I talked at the beginning, Kelly had talked about the tax tip in terms of being able to reduce your taxes by paying your children. It goes further than that from a college planning standpoint. I'm a big fan of working with families to reduce taxes as much as possible, and college planning is a great way to do it. But as I mentioned, you can get the American Opportunity Tax Credit. I see people miss this all the time that have paid, even people that qualify. I see people that pay too much. I see people that are paying more in taxes than it'll cost them for college. If you're a high income earner, if you're not qualifying for that American Opportunity Tax Credit, if you're a business owner, you have tremendous opportunities to do strategic planning and actually be able to save as much as a year of college just on tax planning. Goes beyond that. You could save 4 years of college just based on smart financial planning around how to pay for college. So if this is something you want to do, if you don't want to spend a dollar you didn't need to, then you need to actually get planning. Spending a little bit of money for planning will help you to save tremendously more, and that doesn't even include the amount of peace of mind and less stress. So listen, go to our website, ProCollegePlanners.com. Actually, we have a truncated ProCollegePlan.com. You can go right there, download our free checklist. I mean, it's free. Information on the 2022-2023 year. Go get that, download that right now, because if what you thought was true about paying for college turned out to be not untrue, when would you want to know? I don't know about you, Kirk. I'd want to know it right now. Go get the free checklist today, ProCollegePlanners.com.
Doug, thanks for joining us. And I just want to leave in one chart because Patrick was nice enough to put a bunch of comments here, and I want to kind of respond to it with this one chart. So here's an example of Phoenix, Arizona. This is the buying versus renting calculator, and I point this out because we do this ourselves, but I thought this was a good illustration. So it just shows, if you look at the chart, buying and renting are pretty much in line for the most part, and I think historically that's true. Where buying and renting tend to fall within a certain range of each other, and deciding whether to buy or rent is really just it's a choice, and sometimes it's affordability. There's a lot of reasons it's this way. However, if you look in 2021, there was a huge deviation where buying the cost to buy skyrocketed, and the rents didn't. Right, and in certain parts of the country, rents definitely went up. There's no question about it. But basically, if you look at the relationship between buying and renting, they are very similar. Okay, which means that buying, the home, the cost to buy a home needs to come down, right? Because this spread is too large, and this means that people are not going to be buying; they're going to be renting. At some point, people will smarten up and they're going to decide to buy. So, or they're going to decide to rent. So basically, the point is this is how big of a spread it is. I also want to point out the fact that renting is not going to increase to meet home prices. That's not going to happen because for many reasons. There's not enough rentals, but what happens typically is home prices will lead the way usually, and then they will rents will follow. Right. So what will happen is even though home prices were starting to get skittish, rents were still climbing. Rents are going to start to drop because it comes down to affordability. Right. There's going to be a lot of people looking to rent, but in places like Florida, too many people were looking to rent. So the prices went through the roof. And at some point, that's going to stop because people can no longer afford it. So everything in the real estate space is related, right? Because it all centers around interest rates. If interest rates are rising, prices are going to drop. If they're dropping, prices are going to rise. That's just the natural relationship between real estate and interest rates, and that's not going to change. So, like I said, I can't tell the future, but to me, the numbers are so one-sided. It's hard not to see the forest through the trees. So we're gonna end it there. I just wanted to kind of point that out because it was a great question by Patrick, and all the things that he talks about if you go on LinkedIn, you can see all the comments. If you go there, you can see there's a lot of great comments. However, at the end of the day, when you have things that are this far out of balance, none of the supply demand things are relevant. All of it comes down to affordability. And I want to impress upon that over and over and over again. Look at affordability. There'll be a point where things are back in balance, in which case supply and demand will be very important. But when it's this far out of balance, affordability is the only thing that matters. If you can't afford to buy a home, you're not going to buy a home. And so I want to leave it on that note.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.